Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Monday, February 8th, 2021. We'll quickly just touch on the broad markets. Really no changes since last week, but just levels to watch there. And then I want to do another brief update on the euro and U.S. dollar. I did put out a post this morning with some charts, but I'll just talk on that briefly. And then my common theme, and that is to follow up with the post from last week. Time for Powell to start tapping the brakes. I'm going to show you what I'll be watching for this week and share my thoughts on where I think we're going to, what may shape, what may finally put the brakes on this rally and how that's going to happen. Again, it's a theory, but I'll show you what I'm watching for and some things on the economic calendar this week. All right, starting out, SPY, S&P 500, primary trend line off the March lows, broken about 2 weeks ago, back test, and that's why not much to report. We're about right on the trend line again, another back test there. So, you could say the SPY is on a sell signal, but not without QQQ. As I said, QQQ needs to confirm or the SPY will not go down. There's too many overlap with the top components in the market leading stocks. On Qs, we had that whipsaw signal Friday before last, and that was, again, proved to be a whipsaw primarily, if not exclusively, due to one stock, Alphabet, GOOG, at the time it happened. Said following Tuesday, we had Alphabet and Amazon coming up to report. Alphabet moved up strong. Amazon has been selling off since. That's just a common theme that I'm seeing. That little arrows show. I'm just going through the top 5 FANG stocks, kind of recapping everything I've highlighted recently. Market leaders continue to underperform the broad market, especially small caps, the lower quality stocks like that. You have Apple reported right there, still below there, but still above trend. So this is a key trend line right here, uptrend line, and a longer term trend line that comes in as well. And again, Apple, it's not going down much. It did sell off after earnings, and it's not going up much either. It's still in the trading range. So the big levels here are this box right here, this multi-month trading range, and that trend line right there. So if it can pop above the trend line and get above those previous highs, that's nothing but bullish, at least, especially if these divergences get taken out ultimately. Otherwise, break of the trend line would take us down to that 125.75, and if that goes, and that would be my expectation, if that minor trend line breaks, ultimately it'd take us down to at least the bottom of that trading range. Again, multi-month trading range, big support. A lot of the FANGs have similar support. That's about a 21% drop, but as of now, make it very clear, the trend is up. It's bullish with no sell signals on Apple. Need to see that level get taken out. But that's one that was down since earning. Microsoft is one of the few up since they reported. Here's Microsoft's earnings. They reported on I guess, yeah, that would be that day, Tuesday the 26th, and it's up since then and continues to move up right now. And also, unlike Apple, it broke out of that multi-month trading range and did not fall back within it. So Apple, I didn't mention it, but fell back in that trading range. But again, I said that's okay if it happens and you don't go too far and you hold above that trend line. There's that comparable trend line for Microsoft. So watch Microsoft. So as of now, there's a check mark on the FANGs. That's all I'm talking about right now, the market leaders. Amazon, another one that reported last Tuesday, right after the whipsaw sell signal, and nothing big, but it sold off, put in a bearish engulfing candle the following day. That was earnings report day right there, that little doji, bearish engulfing candle. You now follow through. That's the one thing you want to see when you get a bearish engulfing candle. It is a potential topping stick. It means it engulfed the previous candle, but you need to see follow through to the downside. So we haven't taken out the candle. I like to see, ideally, if it's going to, the sell signal pan out, you need to remain above, well, obviously above the top of the candle. If you move above the top of the candle, then it has no more value. It's not a topping stick because it wouldn't be the top. I like to see you stay about 2/3 below. But again, there's a strong bid in the market, so although Amazon's not going up since earnings, it's not going down much. But again, it is below where it was before it reported. So that's something to note. Tesla, same thing. It's kind of stalled out below where it was. Earnings right around or below. You can see went down after earnings, move back up to about that level, but it needs to break 802 or 800, I'd say, to start a sell signal or correction. Facebook, Another one, again, common theme, the majority of these, if we can populate there it goes, populate the annotations, and it has, it sold off pretty hard after earnings and has only recovered not even half of that drop so far. And like many of the FANGs, it just sits in these multi-month trading ranges. So the stock market, yes, is it at or near new all-time highs? Yep. But the FANGs are most of them below all-time highs. In fact, many of them put all-time highs back there in August. And again, moving sideways. So you take it as bullish or bearish if you want. Glass half full, half empty. Ultimately, the important thing is which way do we get a solid and sustained break above or below those trading ranges, and that will determine probably the next tradable trend in the market right there. Finally, there's that Alphabet. Again, earnings right there, gapped up, and so far it has built on those gains. And so that's what single-handedly put the Qs back up into the into above that trend line after they reported. Okay, so now let's talk real quickly. Let's talk dollar, euro. The euro has a nice clean chart, and the dollar has a clean chart as well. But the dollar index, remember, is comprised of a lot of different currencies. The euro is the biggest one at over 57% weighting, by far the largest component. So it's almost a mirror of the dollar, and so you can use that. Well, there we are. Those divergences so far have played out for a counter trend bounce. Remember, nothing goes straight down, and we also reversed just, a hair above my T3 zone. That's the same level, which was my final target or final near-term target, laid out back months ago. Let's see. Here's that chart I posted this morning, all the way back from December 5th, and that was literally the day before the euro topped, the dollar bottom, and this whole correction started. And it was my first target, second target, 119.52. And so that's what we hit. So again, close enough within mere pips. Pips is kind of like a basis point, but for currencies, that's how they quote that, because they go out to the fourth digit there, fourth or fifth digit. All right, let's go back to the current chart, E7. So there it is. There's that 119.52 level. There's the reversal, positive divergence, and so this is the catalyst. $1 million question is the move over or not. And again, time will tell. We have a downtrend line here, and as I posted this morning, a confluence of resistance. Remember, support once broken becomes resistance. So we have that level there. There's that T2, more of a T2 zone. So it's a resistance zone, and that's going to be near-term bullish. If the euro can break above there, then all these levels on the way down. This was my first target zone way back then. That was hit. There was the top on December 6th or whatever, the day after that first post. First target hit, bounce, bounce, bounce. And so it works in reverse now. Those are resistance levels. So if you get this, that's going to be the catalyst most likely for more upside in the dollar-sensitive assets, which are crude, gold, and I showed you the chart of GL or GC last week and this week. Potential divergence, support right there at 1770. So if the dollar or if the euro takes another jog down, the dollar another jog up, we could have another drop in gold, and if so, it's going to bring gold to that previous reaction low. But so far, we reversed above it, and if we get that scenario, and if it happens soon, we could still have positive divergence. We could still see a rally in gold, and gold, of all the dollar-sensitive assets, as I mentioned recently, it's the only one that's been trading as it normally does, with a tight inverse correlation to the dollar, meaning dollar up or dollar down, gold up, and vice versa. And so that little rally right there, that little jog up off that divergent low that was highlighted last week, that 1829 resistance hit, now taken out. That's the next target if the dollar continues to pull back, and that's DX dollar futures, or you can use UUP if you don't have a futures chart. There's a correction in the dollar. Again, nothing goes straight up forever. So bigger picture, primary trend remains bearish in the dollar. Intermediate term trend, near term trend at least, is the intermediate term trend is bullish, since that divergent low right there. And this is just a correction, again, that was priced into the charts with the divergences and a little bearish rising wedge right there. Dollar broke down, and so that's what the dollar's doing. And so move down here or to that support just below would most likely give us a little more upside in gold. So gold, again, this week looking good as long as this correction lasts. Where it stops, I don't know, but I gave you ranges where it's likely to stop. And then the $1 million question, the really big one, is that it? Is the correction over? That is on that 60-minute chart I just showed you, E7 Euro futures, the initial target I was looking for. But there's a potential in these long-term charts for more downside. I'm moving fast here because I want to cover some commodities and show you some things and then wrap up with my theme for this week, which is the potential to start hearing about inflation. But there's Euro US dollar pair. This is the weekly chart, and so we're right on that long-term primary uptrend line, but we still have that negative divergence. So to me, it's a matter of, do we get another thrust up and then go on to break down and get a correction? Longer term, I still remain bullish on the euro, bearish on the dollar, but near term, I think we're going to get some more downside. And let me tell you what the fundamental catalyst I believe is. Again, now I'm going to loop back to what I talked about last week with time for Powell to start tapping the brakes. So real quickly, I'm going to run to my commodities list, run through it, and just show you. Now we're on daily charts, so what you want to look for are these lows right here, or each and every commodity. Just look at the move. Remember, I use log scaling. See, these are big moves, and I'm just going to rifle through every commodity ETF and ETN I have real quickly and show you, and you'll see the common theme. These guys are in a strong uptrend. Been bullish on these for quite a while. Longer term bullish. Still believe that's the best risk reward out there right now, or one of the best between the various asset classes. Much better than bonds and better than stocks. Again, risk reward. Don't confuse absolute returns with risk reward. Risk reward is how much downside is there. If I had to still, and I'm saying this for a while, I've been saying this for almost a year now. If I had to sail around the world for a year and it could only put my money in one asset class, stocks, bonds, commodities, what would it be? And it would be commodities. And here's a common theme: cotton, BAL. Clearly in an uptrend, and as I've made the point quite a bit recently, I think the case can be made, and you continue to be able to make a stronger case that this move up is not just a bear market rally, but more likely early stage bull market action, because we're taking out in many of these commodities these major previous reaction highs, and that's what differentiates a downtrend from an uptrend. Downtrend is a series of lower lows and lower highs, and an uptrend is a series of lower or higher highs and higher lows. And so there's cotton. Let me just run through the rest. A couple different ETFs on sugar or ETNs. SGG, at a big level now, the ETN is. You have to look at the futures charts to confirm, but again, strong move up. Second target hit. Kane is another one right there. Just a different company. Cow, we're seeing these guys move up now. Cow holds livestock, hogs and cattle. UNG, natural gas, divergent low there. Closer to a 52-week low than a 52-week high, but starting to move up following this divergent low. And doesn't have the impact crude does. Crude has a much higher impact on inflation. PALL, palladium right there, hanging in there so far. There's crude oil, USO up. And again, it's tough to say since that low. And this is just the ETN. The futures, I believe, are up a little bit more. That's 132% off the lows, but solidly in an uptrend. And recently, in shrugging off that rally in the dollar. Again, in the last few days, we had a correction, but the dollar's been moving up steadily, and crude has been shrugging that off. UGA, unleaded gasoline. Big move up. Gas prices, and this is going to be, and it is, starting to be reflected at the pump. And again, it goes to my common theme: inflation. The biggest components of inflation are food, housing, and energy/transportation. I mean, you have to gas your car up, trucks, planes. They're all still, we're moving to a green environment, but they're still, they're going to take energy. Energy is always going to be a cost. It costs money to, pay for the electricity to charge the batteries on your, Tesla and things like that. But either way, this is going to be a big impact. And all right, so we'll get to that in a second, what to look for this week or going forward as far as rumblings about really about the Fed starting to tap the brakes. That's going to be my theme going forward here. Soybeans. Look at soybean prices just skyrocketing. This is not a bear market rally. That's a 60% run, smashing through all the previous reaction lows. Remember, commodities have been in a multi-year bear market. They were until, I believe, recently, and I think this is the start of a new bull market. There'll be corrections along the way, but you can see this one just clearly smashing through all those previous reaction lows, making the case that it's no longer a downtrend, that this is not a bear market rally, rather the start of something new, new uptrend. JJG, one size fits all for the grains, corn, soybean, and wheat. And you're going to see this trickle down. There is no way this does not trickle down to the consumer. General Mills has to pay more for the grains in cereals and bread, and this goes throughout. Farmers have to pay more to feed their cattle, their livestock. And again, it's one of the biggest components of inflation. Wheat breaking out recently here, and again moving up strong off the bottom, hitting all four swing targets. But again, it's a trend trade or an investment. I think wheat and a lot of these can be held for a long time. Corn, huge run up in these grains. Corn, and this is, again, I'm using the ETN, which might understate the actual returns. If you look at the futures are going to give you a much better gauge of the price. These ETNs do a good job but not a perfect job of tracking. That's a 50% run in corn prices since August. That is a huge increase in these grains, and that's a big one right there. So there it is. Corn, coffee. Coffee's, well, it's still longer term. I think looks good. Needs to kind of clear the top of this range. Cocoa, this is a busy chart, but cocoa's been highlighted for last couple years, and most recently a pullback to this trend line right there, and it continues to move up. This is an uptrend. This isn't an uptrend now. Longer term, very bullish. If and when it breaks 35, that will be longer term bullish right there. All right, a couple more. DBA, mentioned this as a one-size-fits-all if you want just exposure to the agricultural agricultural commodities. I'm sorry, this is an ETF. That was a primary downtrend line which was taken out, and again, it's just showing you inflation is, there's all the different lines right there, but that's a simple chart that inflation is here, and it is being, in my opinion, grossly understated in the CPI, and that's what the Fed goes off of. They look at the consumer price index, and I think sooner or later that's going to reflect it. And the thing about inflation, if you get behind the curve, and the Fed and other countries have done this many, many times in the past, and that's where I think Powell is. I think he's almost being negligent in his statements that he doesn't see, and the Fed doesn't see inflation as a risk at all, in his pledge to keep rates low for years to come. I just don't see how you can make that claim, and you're seeing these commodities run up. And again, I'm showing it's not just food; it's everything, including and especially oil and energy prices. GCC, that's just a general commodity, well diversified, has oil, everything, all kinds of commodities in there. There's copper prices right there, and that's it. All right, we could go on and on. There's another general commodity ETF right there, up about 85% since those lows right there. GSG, there it is. Energy is about half of that, and then livestock, agricultural, precious metals, industrial metals. So there's a one-size-fits-all. Okay, so I think I've impressed my point that I can't understand how the Fed is continuing to maintain that they don't see inflation as a risk. And now let's talk about what to look for. Again, because the whole theory is this market is addicted, and people believe that if we're going to have uber low zero rates for years to come, yes, that is a bullish fundamental factor for the market. But when the Fed realizes, oops, guess what, inflation's running a little hotter than we thought, and they start talking it down, and it'll be gradual. That's I can mark my words on that. They're not going to pull a complete 180 because the market would just crash. What I think will happen is And we'll go here. You can go to the right side of the chart. You click on resources right here at the top, and you have tools of the trade down here. And you click on economic calendar, and it's going to pull up the economic calendar. So here's what I'm looking for. And again, this could be this week. It's going to be a gradual thing. It could take months before the market you start hearing a lot of buzz, but you want to see, I think the way it'll work is these Fed members here. So that's Loretta Mester speaks today at 12 p.m. Now I don't know much about each and every one of the Fed members. I know Bullard carries a lot of weight. James Bullard talks tomorrow. Noon, and then of course the king, probably the most powerful man in the world. I think most would agree on that. Jerome Powell talks at 2 p.m. So I think what I said in that post last week, I think gradually you'll start to see little bits here and there because it's not unusual. In fact, you're always going to get some of the Fed members that might not agree with Powell or each other. So and again, there's some voting members, non-voting members, but what they say will ultimately carry weight, and I think that's what you want to look for. So, in other words, is she hawkish or dovish tomorrow? Is he hawkish or dovish? Did they start dropping a few clues about, okay, we're seeing some inflation, and again, that's how they'll talk the market down gradually. And ultimately, sooner or later, you want to watch, of course, the CPI and then other things. There's a lot on the calendar here. For example, tomorrow we have, let's see, it's coming up here, Wednesday, Atlanta Fed business inflation expectations, little things like this. Of course, crude oil we'll continue to watch, jobless claims, everything else. And there's another Fed member there, John Williams, on Friday. But again, we'll have Powell on Wednesday. We'll see what he says. Okay, and then how to make money on all this stuff. You can, like I said, the oil has been going up. It was going up even when the dollar was rising, which is unusual. And of course, we got the pullback in the dollar this week, and that gave a little more boost to oil. But I'm going to get to something in a second here on oil and the energy stocks. But as I mentioned, gold. If we continue to correct in the dollar or even hold out where we are now, that's your likely next target right there. And don't forget the bigger picture. Going back for months, mentioned that gold, I remain longer term bullish on gold, and there's a buy zone. We got close enough to it. We're not there yet. We might not get all the way back down there again. That's that buy zone that I highlighted right here. The day we hit the top of it, we got that nice spike. So I still maintain, gold for a longer term investor. You could scale in anywhere, from the top down to the bottom, but not below. Below that, it's big support. Gold should hold there, and I believe it will. And again, we may not get to the bottom of the buy zone. That's why it's a buy zone. It's a scale in zone. In fact, we already hit it once. We may never even hit it again. But for now, the charts aren't screaming. We'll continue to monitor the euro, the dollar, and of course gold itself, and I'll give you updates as needed. So long term, not a lot in the chart. Short term, I showed you the 60-minute chart of GC, so I think there's a trade to be made there. Although if we get rejected here in the euro, this is a 60-minute chart, there's a trend line, we can come back down, and I'll tell you, this is a very real possibility. If this happens, you'll probably see that one more leg down in gold to that previous reaction low. So you have to just be nimble. If we go to break the upside, that's going to be bullish for gold. And if we pull back down here to hit, anywhere, to the top or the bottom of that T3 zone, that's going to be near-term bearish. Could probably bring gold back down, and then we may get another long entry on gold if and when that happens. Okay, and to wrap the video up, let's just talk about another dollar-sensitive asset, and that is crude. And then we'll talk about the energy stocks and we'll conclude the video here. This is a 60-minute chart of CL, crude futures. We had several reaction highs here to 53.90. We finally broke out, but we're diverging. At this point in time, we have some pretty good divergences building. And this would mesh with a rejection here in the euro, pullback in the euro, another leg up in the dollar, would take gold or crude back down to at very least that breakout there about 53.89. And again, if and when it happens, if it happened right now, that'd be about a 7% drop. And if it's much more than that, if the dollar is going to continue to rally, the euro continues to pull back, then you could see any or all of these additional targets hit, and that would be a big drop up to about 13-14% if we got all the way down here to that 49.86 level. Pretty big support, at that 51.80 level along the way there. So you probably get reactions at each of those levels. No sell signals in an uptrend, just like the market. So just something to watch as a setup. I want to get these out in advance because when the turn comes, it can come very fast. I think we'll see a crowded rush for the exits in crude. Now, as far as the energy stocks go, just a quick recap. This is XLE. This is where it was highlighted, and it was mainly XOP I was zeroing in on a couple weeks back. We were at resistance because XLE reversed shy of resistance so far, about 47. And the bigger picture is this was bullish. XLE took out the primary downtrend line, breakout back test that was highlighted then, and that's just a reaction off there. I do want to point out we are still below where we were when we put in that divergent high. Remember that the whole point of that pullback, which we got, we hit the first target in XOP, hit it perfectly and bounced, and that's where a reaction was expected. Now the $1,000,000 question, I'll get to XOP in a second, is it a counter trend bounce with another leg down to come, or was that it for the correction? Sometimes, and that's why I list multiple targets. Sometimes my first target gets hit if I have two targets, as in the case of XOP, and you may never see the second one. But I can tell you breakout backtest, and I did mention it in advance and at the time. If you're bullish on energy stocks, you can go long there. But we didn't take out the previous high yet. That is still very big resistance. I can say this right now. If and when we get to 47 on XLE, I expect a pullback. That would be a good time to exit longs if you're in them, or put on a short trade for a pullback trade, because I think we'll get that. XOP, well, let me hit XES first, then we'll go to XOP. XES, this is right where, I said a couple weeks back we were at resistance, 55.44, and that's where the pullback came, and it hit that first target. These are the same levels that were on the chart, I believe, back then. 47.75, we hit it for quite a while, and so far bounced, but we are still below where we peaked out there before. So it all depends. Watch crude oil. If crude breaks, then XCS and XLE and XOP, they'll probably have another leg down. XCS has never come in to backtest this trend line. I showed you on a minute ago. XLE, we did backtest the trend line. So, and we don't have to backtest the trend line. Keep in mind, this is longer term bullish, this breakout right here, until and unless that fails. That's the primary downtrend line on XES. Comes all the way back from 2018. Quite a few reactions. So I'm just showing you levels to watch. If it can pop above 55.44, then we're probably going to go up there to 64.30. And just like I said a minute ago on XLE, if we get to that, I'll call it the comparable resistance level, I think it would be a great time to exit longs and or go short, because we're going to have, if it happens soon, we're going to have the same negative divergence we have now. It'll just be bigger. But we could also come in and backtest. And so I'm going to, again, it's all about crude and the dollar and everything else I'm covering. That's why I'm saying, look, it can go either way, but the clues are going to be what the dollar does, what the euro does, and we'll watch some of these big energy stocks. And finally, last but not least, then we'll wrap this up, XOP. XOP, again, highlighted a few weeks back as a objective short at resistance, 71.53. We got that pullback, and it was, pretty decent. What did it measure out to so far? That from the divergent high to that first target of 63.71, right there where the crosshairs are, that was about almost a 12% drop. So it was good for that, or 2 times that in drip. Of course, leveraged, because drip is 200% leveraged. And then bigger picture is this. You have the downtrend line, again, going back to 2018. Let me brighten that up so you can see that on the video. There's the primary downtrend line. So bullish when that was taken out right there. And we hit that resistance, and as expected, pulled back. That was that drop right there I just showed you on the 60-minute chart. But what we did is we put in a divergent high, and we had this bearish rising wedge. And you can see as I zoom in real tight, breakdown, hit support, bounced, and we're back testing. So if and when we get that correction, that drop in crude, if it happens soon, we're probably going to get another leg down, probably come back to that 63.50 support once again, and quite possibly, and based on these divergences, I think likely come in and back test the trend line here on XOP and that comparable trend line on XES. Should crude continue to rally, we're not far away from even more significant resistance. Where I highlighted this level here, that's 71.53 a few weeks ago. This 80.35 is an even bigger level right there. This is really where crude was holding support, broke it there, back tested once, and never looked back. And then you had one of the biggest drops in years on XOP, that is, these energy stocks. So that's a big level. So, okay, if I'm confusing you, here's what I would say. The upside in right now in XOP, in my opinion, before a major reaction is limited to about 10%. And that's a decent move. However, almost equal odds whether we're going to do that or get rejected here, come back for another move down, potentially do this. Again, it's all going to depend on what I see, and maybe this week, maybe Powell will be, or another Bullard or one of these guys talking this week, one of the Fed members will be the catalyst. For tapping the brakes, and so just so you understand, any shift, even a slight perception of a shift towards a more hawkish stance. By hawkish, that means the Fed is more likely to raise interest rates. Dovish means they're bearish, or likely to keep rates lower, go lower. Well, there's no lower. What that would do, it's bullish for the dollar, because when our rates go up, if we're raising rates, or again, if we don't have to raise them, just the talk of it, or the perception, if that happens, that is bullish for the dollar. And again, a rising dollar is bearish for energy stocks. That correction and that rally I called for in the dollar and the correction in the euro, it was not mere coincidence. It was the catalyst for this drop in the energy stocks. And then recently we've seen this bounce back here. Okay, so I think my thoughts are clear. The levels are clear. The things to watch for, they're all interrelated. I won't go through all the components of XLE or XOP we're on, but the big ones are, XOM, ExxonMobil, right back to where it was a few weeks ago at resistance. There's that next level there. 50-50 if we're going to pop up there, but if we do, it's big resistance on ExxonMobil. And that is, from where we're at now, it's not too far. It's about 6-7%. CVX is still below. And so there's, like I said, I can make, and I hate this when this happens, but I can make a decent near-term bearish or bullish case. But a lot of these stocks have broken down, and like this is a big one. CVX still below where it was a few weeks back when I mentioned that resistance. EOG breakdown below trend. PSX breakdown below trend. MPC broke down but extended the divergence. VLO, and I can go on, but that's the common theme here. We still have negative divergence on a lot of these. So we got the initial pullback, but is there one more to come? And like I said, I think it'll be largely dependent on what oil and the dollar does going forward. All right, I'm going to wrap this up, get the video out to you guys. If I see anything else, I'm not seeing a lot of objective setups. The commodities continue to rise, commodity-related stocks, things I've covered in the past, and recently I've been bullish on, like these ag input stocks. I've been bullish on the commodities for so long, agricultural commodities. I highlighted this sector a few months back, saying this one will play the game. It's set up technically to catch up, and we have seen that. MBII, I forget where the breakout was originally posted, but we're up 140% since this last trend line breakout continues to rally. Move up strong, up 18% today, and a lot of the ones in the sector too that I highlighted. CGA already hit that second target, might be flagging there. So there are these opportunities, but they're not as objective anymore. In fact, the other way around. At this point in time, a lot of these are at resistance, coming up to downtrend line resistance. So the odds for correction are increasing with every tick higher. And I missed a move in the cannabis stocks recently. They've been rallying. They were set up constructively, and I didn't have my eye on the ball there. But now they're not objective anymore. So I just want you to know, trade ideas remain light. I'm sharing a lot of setups, and a lot of those setups will be on the short side. We just need the catalyst. It's been very, very hard to find objective long side setups that don't appear to have a lot of risk, with attractive risk reward profiles, meaning a lot of upside potential with minimal downside risk. All right, I will wrap it up here, get the video out to you guys, and if I come across anything new, I'll get another video or some charts out to you today. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.